So can we start, sir?
Yeah, let's start. Sure.
Good afternoon, everyone. Today I'm pleased to extend a warm and hearty welcome to Mr. Tushar Kansal, founder and CEO of Consultancy Ventures, who will be sharing his insightful thoughts on venture capital and role of professionals. Tushar sir is an accomplished professional, a thought leader, and a thought influencer. Over the years, Tushar sir has supported startups and growth stage companies in diverse sectors. Tushar sir is a venture advisor with Loyal VC, the INSEAD-led Canadian VC. He is a mentor and judge of startup pitch events at entrepreneurship cells of top academic institutions. Without further delay, I would like to invite Tushar sir to share his valuable insights and experience with all of you.
Thank you so much, Nishant. Let me start by saying that this presentation I did for a US uh, CFA institution, and they really wanted to know that CFA is very popular for venture capital companies. So how is it in India? So I gave this talk for them. I'll just do my full screen. Just a minute. Yeah. Okay, so this presentation is on professionals who can aspire to create a career in venture capital. This is about me, already given by Nischint. So thank you so much. I've done more than 300 talks and events. You can search on Google and YouTube. And also, right now, we have invested in 300 companies across 60 countries through the INSEAD-led Canadian VC fund called Loyal VC. Uh, Okay, so this is the way VC funding happens. Initially, you have an idea, and you want to get money for it, and people mostly who will fund you at that stage will be friends and family, FNF. Mostly because they know you, they know your capability, and a lot of times I get students coming to me saying that they are at idea stage and they look for some seed funding. So definitely there are platforms who give you that, for example, incubators and accelerators, and the government has also the Startup India scheme. So right now we are in the process of helping IIT Ropar and IIM Udaipur for getting their funding done to various startups, and the funding is around 25 lakhs to 50 lakhs. So if you are a less than 2-year-old company, you have some technology, then you can get this 25 to 50 lakhs, and you don't have to shell out a large equity. The equity you have to give is in the range of 5 to 8%. So there is no control with the investor. It's outside the control, and you get a neat 25 to 50 lakhs. So you are able to design the product and reach a stage where you can interest the VC fund guys, because the VC fund guys, they don't come in at very early stage. They typically like to come in, like there is pre-seed, seed, pre-series A, and then the funding happens series A, series B, series C, series D, and so on. So the VC fund guys typically like to come in at pre-series A and beyond that. I'll give you the rationale for that also. So then, after the friends and family, there is angel investors. So typically, if suppose nowadays after the Shark Tank, everybody is an angel investor. They like to put in money in early stage startups, and the industrialist, the CXO, even the a housewife wants to make money by investing. And that's the beauty of venture capital, that it is able to attract a huge number of people from all walks of life because of certain number of reasons, which I'll be happy to discuss later on. So early stage funding happens, then the venture capitalists come in, then the late stage funding happens when the private equity guys come in, and after the private equity guys come in, then the company goes in for an IPO typically. Now it's not easy to do an IPO. It has never been easy, because if you want to get your valuation, it really depends on the market conditions. So if the markets are doing well, then they typically you get a good chance to get a good valuation. And because there are a lot of investors sitting on your capital table, your cap table, and they are sitting at a particular valuation, so they would want you to list at a very good valuation. So just to give you an example, Mama Earth IPO was planned at 23,000 crore valuation. They have a profit of 25 crores. So on 25 crores, nobody was giving them 23,000 crore valuation. And now the IPO is coming at 10,000 crore valuation, which is 400 times profit. So if you are a traditional person, you have a family business, our elders, they have always been in government jobs or in some small private business or maybe some manufacturing industry. They always tell you, beta, you earn from profit. But the thing is, if you were a Mama Earth promoter and you were earning from profit and not bothering about your balance sheet, just bothering about your profit and loss, then you will be happy with 25 crores. But you don't know that there is a Alibaba's cave which is available outside out there, which is called private investments, which is called the stock markets. And uh, if they list at 10,000 crore, imagine what their 50% stake will be. It will be 55,000 crore. So, if they were sitting happy making 25 crore profit for the next 10 years, they would have made maybe 250, 500,000 crore. But now they are sitting on 5,000 crore gain. That is the beauty of venture capital. Now, the amongst the financing options nowadays, there are angel networks like Mumbai Angels, Indian Angel Network, V Founder Circle, FARD Network, and what they do is they tell the angels that we will pitch you a company every week, and the minimum investment which the angel investor has to make is between 2 to 5 lakhs, and they can make even larger. So that's how they invest. And the VC fund guys, what happens is there is a MVP, minimum viable product. That is a product which will sell in the market. So you are creating that product as a tech guy or as a non-tech guy, but once you reach a MVP stage, then you start getting little bit higher funding. But typically VC fund guys, they like to come in when the product is there and you also have created the pricing and different variations of the product, and you also have done your market primary and secondary research, and you also have sold some of these products already, so you have validated the market for your product. That is called product market fit, PMF. 90% of venture fund guys like to come in post PMF because it is the least risky. The product has already established that it has a founder, the pricing has been decided, the market research has been done, and all the VC fund guy needs to do is he needs to put in his money. The money will go majorly in marketing. In fact, I have some VC guys telling me that 92% of what they invest at pre-series A and series A goes into marketing. And as it goes into marketing, it starts selling maybe through distributors or online platforms. And then the valuation of the company goes up because the revenue goes up. So it becomes a very simple game. Then there are micro VCs. What is happening is that a lot of these funds, they are coming early now. Like Sequoia used to come at Series B, Series C. Now it is coming at Series A, pre-Series A. That is because they feel that once they come in Series B and Series C, the valuation is already so high. So, for example, this company Instacart recently was listed in the US stock exchanges, and we were doing an analysis of which investors made what kind of a return. And you'll be surprised to know that uh, only the investor which came in at pre-series A and series A made a profit on the IPO, made a capital gain on the IPO. All the other Series B, Series C, Series D, they came in at such high valuations, and Instacart did not get that kind of a valuation in the IPO, so they would have sold for a loss in the IPO. Next, I have a question for you. Although I don't want to make it very long, so I have given the answer as well. Uh, a pre-series A round in a startup in India is likely to be what kind of a ticket? Is it $1 to $2 million, 750K, 250K, or 100K? The answer is $1 to $2 million, typically around 8 to 16, 17 crores. Now, there are key financing options other than angel networks and VC funds. There is corporate venture capital. So what happens is a guy is sitting in IIT or IIM, he opens a startup. He's at loss to understand a large number of things, how to approach the distributor, what is the pricing at which he should sell his product, what is the working capital, in how much time can he expect his money to come, uh, how much to spend in digital marketing. Should he spend in the sponsored ads on Instagram, or should he go in for a more serious and costly kind of option like Twitter and LinkedIn marketing? All these things he doesn't know. So he's relying on his close circle, a management team, and some mentors. But then, corporates have created their own venture capital arms. So what they do is they invest the money, and because they have the experience in running a business, they will advise you in all the areas like the strategy, like what lawyers to keep at what price, what CACS, what marketing companies to keep at what price, what is the strategy you need to follow. For example, if today you want to open a retail chain and you get the help of Mr. Damani of DMart, imagine what that can do for you, for your business, because you won't be learning by making mistakes. You'll already have a person who will give you validated relationships, validated management know-how, validated capital, and uh, a name in the market that this person is backing you. That is why people run after Kunal Shah of Cred, because he has put in small checks, $50,000 in more than 300 companies. But you become a Kunal Shah funded company, and it comes with some added advantages like you won't be making serious mistakes in the market. Then there are venture debt funds. So imagine if you are a startup, you want to get funding. Money is always an issue. You can't go to the banks because the bank will charge you 18% for an unsecured loan. If at all he gives you the loan, then you have to go for a secured loan option, but you don't have the property to give as a collateral. You can't ask your parents. They will say we are in a retired zone. We don't like to bet on our property. So what do you do? So you have the venture debt fund option, which means that it will be unsecured. They will give you a large amount of money which the bank doesn't give, but at the same time they will want to have some additional return, and that return they can make by taking some warrants or some upside on the equity also. So the valuation goes from 100 crores to 500 crores. So naturally, they will say that we are getting 12% interest rate plus some upside on the valuation gain which has happened. Then there are government grants, like I told you, the Startup India program, and SIDBI has a 10,000 crore fund of funds through which they invest in venture capital funds. So they are basically a funder for venture capital, and a large part of that 10,000 crore has already been distributed. And a lot of funds are holding them, like Bloom has got funding from SIDBI. Now the question is, what are the hygiene factors which a venture debt fund usually considers before making it investment decision? Imagine a venture debt fund invests, and then the next round doesn't happen. So the guy loses 100% of its money. So they have certain hygiene factors. So one is the startup should not have a solo founder, because it's risky. The guy goes broke or the guy goes bonkers, then the business is gone. The startup should already be funded by an external investor, equity investor, so that there is some liquidity on the balance sheet of the company. And that liquidity, further investors who come in, they always say that there should always be some investor already sitting on the capital table. So that gives them some comfort. The third thing they ask is that the startup should be on a growth path, a tearing growth path. It should be really doing well. Like you have, uh, the company which was sold to Baiju's White Hat Junior. At the time when it was sold for 300 million, I think $120 million, it was already clocking a 60% growth rate annually. So that was a big, those headwinds, those that growth path was there, which the investor really liked. Then the cash flows of the startup should support the payments for the debt. Of course, the cash flows like the interest and the principal. So all these four are correct when we ask this question that what would a VC fund, a venture debt fund guy want? Then other options like accelerators and incubators, they typically give you a co-working space. They give you a Wi-Fi. They give you a CA, CS, lawyer, cheap agencies, and they charge between 3 to 8% of equity. But they give you co-working for a limited time, like a 1 year. So post that you need to pay, of course. And they call mentors from the industry who address you on joint sessions. If you like some mentor who's relevant to your business, you can of course strike a personal deal by saying that we'll be giving you something like 1.5 to 3 4% or 2% kind of equity. In some cases, if your cash flows are good, you can offer a monthly retainer also, along with a small equity. Then there are family offices. How are family offices different from VC funds? So suppose there is a shipping company, Great Eastern Shipping. It's very well known because there are very few private shipping companies in India. It's quite a big mess out there. So Great Eastern Shipping is one of them. It has kind of a monopoly on certain routes. So they wanted to diversify because shipping is very much dependent on government regulations. The moment government changes a regulation, the shipping goes haywire. So they have created a family office, Jesco family office. I'm giving you one example. So what they do is that any business which has some kind of a synergy with a shipping company, they will put money. Of course, the shipping money will help that company, so the value of that business will go up. For example, one of my friends who was from IIM Lucknow, he created a logistics company. And Snapdeal at that time was outsourcing its logistics, and that was almost a 300 crore kind of business. So he said to Snapdeal, why are you outsourcing 300 crores annual business? You can do it in house, or I can do it for you, and you can put in money in my company. So they gave him a not a good deal, but end of the day, they left some equity for him, took majority equity, and they transferred the entire 300 crores into that company. So the independent valuation of that business itself was so huge that there was no point for Snapdeal to outsource the business to a third party. So that's what family offices do. And then there are banks. As I told you, they are very conservative players. Why is HDFC Bank amongst the top global banks, the only Indian bank? Because it's conservative. It will never do corporate lending. Not never give 5,000 crore, 10,000 crore, 20,000 crore kind of project loans. It will never do that. It will do only retail lending. And because it will do only retail lending, so it will see that what are the salary slips, last 3 year income tax returns, and the CIBIL score. And once that is established, it will give very costly unsecured loan. So the chances of that person not paying you back is very less, because that person is on a salary, and he needs to have a certain level of consumption, and he's comfortable that he's already getting a salary. So that's how HDFC Bank is the shares of HDFC Bank, they run at a huge premium to the shares of Kotak and SBI and others. Then there are crowdfunding companies, a lot of websites like AngelList, and the angels can they can register there, and they will have a lot of information of a lot of startups, and everybody can pool in a certain amount of money. Then the question is, how many accelerators does India have as of now, as per NASCOM? Now you would have thought like 250 is a big figure, but actually it is more than 1,000. Then another is revenue-based financing. So what happens is you are a consumer startup. Now you have cash flows. And you have the visibility of the cash flows also, because a large part of your, maybe you are a D2C company. So your revenues are coming online. Now, what happens is that you don't have the property to give as collateral for a loan, and the venture debt guys also say that you are too small for us right now. We will give not less than 10 crores or 50 crores. So what they do is, like, there are certain startups like Club and GetVantage. What they do is they will give you funding for 6 months to 1 year. That will be a debt funding. But what they will do is they will deduct the entire year's interest beforehand, before giving you the money. So they are safe on the interest side. For the principal, since you are getting your revenue through a payment gateway, they will put a escrow there. So first their principal will be deducted every month, and then the balance revenue will come into your account. So they are safe guarding themselves, they are safeguarding their risk by uh, making a waterfall on your payment gateway revenue, which is coming. So this is it. Now, one more question. Imagine a revenue-based financing company which relies on the cash flow, the revenue generated by you. Um, so what is it more suited for? The question is it suited for artificial intelligence and machine learning companies or consumer companies with an online platform? Is it suited for old economy like those trucking companies? And is it suited for retail chains like brick and mortar? So the obvious answer, it is suited for consumer startups with an online platform. Now, a VC fund, you have to understand how it operates. It takes money from investors and invests that money and says that I will make a return and give it back to you in 5 to 8 to 10 years. Uh, so the team size is very small, because end of the day, once they invest their money, there is hardly any work. You just have to take follow-ups from the investee companies, check their cash flow, whether they are not running out of cash, and then keep on helping them with relationships, like you get them a meeting with a big IPO investor sometime, and all those things. It's a long-term relationship. A VC fund guy puts in money, he stays there for 3 years to 5 years if it is an Indian investor, and he stays there for 5 to 10 years if it is a foreign investor. If it is a even larger foreign investor like a pension fund or a endowment fund or a university fund, it stays even beyond 10 years. So that it's a relationship you need to have with the founders. So what is the team composed of? It is composed of an analyst, then there is an associate which helps in deal sourcing and managing the portfolio, and then there are certain senior people in the team who help the principal. Principal heads the team, and principal, if he does the job very well for the next 3 4 years, he will become a general partner. General partner is the guy who makes the decision where to invest, and the people who put in the money in the fund are called limited partners. And how the money gets distributed is, suppose he has taken 100 crores from 10 limited partners. Then he will deduct 2% every year. So 2 crores every year, just to manage his expenses like office, auditor, accountant, internet, and everything. And apart from that, once the money gets invested and gets sold, there is an exit. Then out of the capital gain which is made on that investment, 20% will be kept by the fund and 80% will be returned back to the investor. Now imagine if they invested 100 crores, and out of 10 investments, two became super hits and they exited at 1,000 crore. So 200 crore comes to the fund as capital gain, their share. And that 200 crore will get distributed in the team also, but majorly will be taken by the GP, general partner, who had sponsored the fund initially and who had raised the money from the limited partners. But a lot of money gets distributed. Like this guy Sonal was there. He was my college senior. He was in Adaptability private equity. They got some very good exits. I remember in 2005, this guy had bought 15 apartments in Gurgaon. So, I mean, that's the kind of money we are talking about here. Okay, so there's a CFO as well for the fund because uh, the fund guys, they are mostly from IITs and IIMs like you, and they have very complicated terms which they use, and they have a lot of, lot of things they calculate all the time. So the CFO is needed full time, and I'll share this presentation with you. Of course, you can see the major responsibilities of how the CFO will handle, because the CFO has to handle limited partners money. At the same time, he has to handle the money which has got invested in 10, 15, 20 companies, which is a huge work by itself. And what happens is that once you invest the money, you want that future rounds of those companies should keep on happening. So you have to liaison and network with a lot of other VC funds and private equity guys. So all that is a lot of financial work. So that's how CFO is required. Now, question is, which designated team member working in a VC firm is most likely to be on maximum number of external calls? So the answer is an analyst, because an analyst gets 20 new deals every day, and most of them are cold emails, and he gets bombarded with deals. So so that's why the most busy guy is the analyst.
So the
Now,
better,
hello,
two classes.
hello.
Sorry, sir, that was.
Okay, sure. Now, more careers in the field, accountants and auditors, because the capital gain has to be calculated properly, the money has to be distributed properly, and most of these big investors in the funds, the pension funds, endowment funds, they will also always tell you keep a big four auditor, keep a big 10 lawyer, Amarchand Mangaldas, keep and keep PricewaterhouseCoopers. They want this basic level, so that because these are entities which who are handling big money, so they can't have anything hanky panky happening. The analyst guys, let me tell you, I am Ranchi. Although you are, some of you might be from HR, but IIMs are the favorite hunting ground for venture capital funds. But one has to make a name in this field as a guy who understands what investing is. And it is not just about seeing pitch decks, questioning the founders, and being very happy that the founder is really chasing you. It is a lot of discipline. If you there's an investment thesis you have, that you'll invest in this particular sector this much amount, and maybe you have some money reserved for the follow on rounds. So there's a thesis for every fund. You have to be very disciplined and follow the thesis. Sometimes this thesis works reverse also. For example, this there was a company owned by one of my friends, American Swan. He had created the name as sounding of an American company because there was brand benefit in look sounding American. And one of the Malaysian funds had put in $20 million. And initially, what happened was that they were doing a huge cash burn because they were paying the entire digital marketing, sponsored ads, they were paying to Google and Facebook. So, I mean, they were really paying in millions of dollars out of that 20 million. So this guy started telling the Malaysian fund that maybe we should go on a hybrid model. So some online and some offline. Like if anybody wants to create a retail business in India, if you just have a presence in top 25 malls, then your brand gets built, because the malls are in two categories. Either they are shut down and not working well, or they are working so well that they are charging a huge rental. So if you have a presence in those 25 malls, plus you are selling by your own website, plus maybe selling on Myntra, and so your omni-channel strategy is there, and the brand gets built. But the investment thesis of the Malaysian fund was only to invest in online businesses. So they did not allow him to go hybrid. And the company ultimately closed down. And out of $20 million, when they calculated, they had given $12 million to Facebook and Google for sponsored advertisement. So, so this is how thesis sometimes works reverse. Uh, so you have to have an eye for what will work. Which founder has the X factor? Which founder is really passionate about solving that problem for which he's raising money? So you have to be very disciplined in the way you approach it. Then there are investor relations specialists, because you'll have to manage your relationship with the LPs also and with the startups also. So it's a full-time job. Managing a relationship with your investee, managing your relationship with your investor. It is a full-time job. So that's why you have an investor relations specialist. Then you have marketing specialist, because you want the quality of your pipeline, the deals which come to you to be very good. And you want that. Now today Sequoia, everybody wants to raise money from Sequoia, because they know that once we become a Sequoia funded company, our future rounds are quite secured. So you have to have that gold plated name. For that, you'll have to do a lot of PR. You'll have to do a lot of I did almost 51 shows for venture capital. We used to have global investors and roundtables, and we used to discuss sectors and give our thoughts. And that was basically our go-to-market strategy. That you have to have a name as a knowledge-driven fund, as a fund who can spot winners, as a fund who supports startups, as a fund who knows the sector and who will provide business relationship, investor relationship, management know-how, and capital. So for creating that kind of aura around you, that kind of a promise in the market, you have to have marketing specialists. And then there are lawyers, which are very, very much needed in a VC fund. Then principals are the one who head the team. There are risk managers, for example, who will tell you that uh, don't invest in that particular country because this sector is at risk in that particular country. So, for example, nobody could see that China will clamp down on gaming companies. China will clamp down on edtech companies. But if the risk managers would have been able to see it, they would not have put money in the huge Chinese companies, all of whose shares have really crashed post the government crackdown. Now, what is the ideal team size in a 50 million VC fund? The answer is 10. 5 is too less. 15 and 20 is too much, because we create a huddle to decide where to invest and to make decisions. And the more the decision makers, the quality of the decision goes down. So, that's why 10 is the ideal number. Now, how to make a career in VC and startup ecosystem? Uh, you need mathematical skills. You need business and economic understanding, negotiation. You need to know that you have to push the paddle or pull it back. So so whether the other person is more needful or you are more needful. So there are most of the deals who come there, the founder is needful. So you don't need to push the paddle. The founder will itself say, just give me the money and accept a lot of things. But when the deal comes, sir, we are raising 50 crore. We have tied up 40 crore from these 4 funds. We just need balance 10. Then, you are against the wall. You will have to accept everything, more or less, the valuation, the terms, because you want to be in a deal in which 4 people are already there. Because that will ensure a lot of liquidity in the cap table in the future rounds. So you have to all these skills. You need to be the biggest thing I've seen with successful VC guys and successful founders. They are voracious readers. You read a lot of books. Um, in fact, Bill Gates says that he goes for a week at some place where the mobile is not there, and he just takes some books which have been recommended by his peers in the market, and he just reads books. So, Warren Buffett is on record to say that he reads a lot of books. So, most of these people never read fiction. They will only read non-fiction, and they will read somebody who has come out with a new thought in the market. Like, Black Swan, Nassim Taleb came out that there are Black Swan events like the COVID, and everybody wanted to read Black Swan. So that is the one of the things you need to have. Then you can enter pre-MBA also. You can take an internship if you are from Christ University or I don't know some good graduate college. Post MBA you can join. Of course, you'll start from quite low, and then once you have an independent name in the market, then somebody will pick you as a partner and give you a good share of the capital gain, which will happen. Um, and if you keep on persisting beyond that, maybe one day you will soon have your own fund because you will become a GP because uh, all those LPs know you. So they will say, buddy, I will give you money. You start your own fund. So that is what happens in a huge number. Like K Capital, we had one of the guys, I'm forgetting his name, and he opened a Singapore fund, Carpe Diem, and now his own fund is bigger than K Capital. So the LPs put a lot of trust in this guy. You can do a degree economics. You can do in many cases, um, and you can be from the investment banking side or the financial services side, consulting side as well. Bain and BCG and McKinsey. Uh, and you can be from product development side also, because if you understand the journey of a product, it will really help you in making the investment decision, because you will be able to understand whether the product the other guy is saying that he has created is genuine or not. And secondly, if it is genuine, whether it has a wherewithal to compete in the market. So product management guys can also do. Now the question is, what is the most preferred route for those wanting to build a career in venture capital? Answer is either Ivy League MBA plus being a startup founder yourself, or you can do BCom, BSc Economics, and add a CFA and MBA with that. CA plus CS plus law. I mean, I've not seen very many CAs become VCs, because they look at things from an accounting perspective, and they always see इसमें ये घपला है, इसमें वो घपला है. They always tend to be overcritical. That's what my personal view is, what I've seen. And engineering plus MTech will suit more for the technology side of the fund, where the technology team sits to analyze the technology, whether the technology created by the founder is genuine or not. So they have a tech team also. So there the engineering plus MTech guys can come in. Now, 2023, the VC funds investments have come down. Not a huge amount, but overall, India is still doing better as compared to China. And 44 unicorns were minted in 2022 in India. Now, how many unicorns? Unicorn means a startup with a valuation of more than $1 billion. So how many unicorns are there right now? It is more than 107. So this is it. I'm open to any questions. I hope I made some sense, and thank you all for your valuable time. Nishant?
Yes, sir. So we have questions, sir. Aminda, please go ahead.
Yes, sir. Sir, you mentioned that we can start investing in these if we have funds above 2 lakh and it can go beyond. So what kind of platforms would you suggest for someone who's only looking for investing a lower amount, somewhere between 2 to 3 to 5?
So if you register with the FARD network, V Founder Circle, Mumbai Angels, Indian Angel Network, and you if you search on Google, the top 10 of this year will come. So you register with 4 or 5 of them. So every Saturday the pitching happens. So they will send you a link that you come for the pitching, and the minimum amount that can be invested is in most cases 2 lakhs. In some cases, it is 5 lakhs and beyond when the companies are more mature companies. And they will deduct 5% of the money which is being put in by you. And what they will do is out of 5% they are deducting from your money, 2% they will invest back in the same round in the same valuation. So basically, to give you a confidence that we are also putting in money in the same valuation in the same company, and once the exit happens, your exit happens from in that company in the future, they will take 10% capital gain on that. So this is how they work, and you can also list on Angel List and Let's Venture. So that will also aid you in becoming a angel investor.
And so, does these investments have to be recurring? Like, I have to invest in every like quarterly or half yearly
No,
or
no, no,
monthly
nothing
basis?
like. There are no hard conditions. If you
Got
want
it.
to invest, you invest. If you even if initially you show a soft commitment, they will start giving you a link of the data room on the internet. So you see all the files. You ask a huge number of questions, and even in the future, the investor calls will happen, and you can keep on asking questions because you have put in the money.
Got it, sir. Thank you so much.
One thing I want to tell everybody is to let's get added on LinkedIn, because I'm very, very active on LinkedIn, and we can be in touch. So if Nishchint can share my LinkedIn with every one of you, or maybe I can put it on the chat here if you don't mind.
Sure, sir, I'll share it.
Okay, sure.
Deepthi, you can go ahead.
Uh, yeah. Good afternoon, sir. Thanks for this session. I have a question in my mind that during times of COVID, we saw that the deals of the funds closed and the exit has reduced considerably in the PEVC phase. Um, so suppose someone is the GP of a fund, of a VC fund, and during these times there is a lot of cash burn, right?
Hmm.
For more adaptability in the markets, and also one cannot exit because of low exit multiples. So what are some of the strategies that were adopted during this time by these BVC firms?
See, the biggest strategy is you have to be very, very battamiz in extracting the money from the customer. Look at Zomato. I mean, every button you press, it will ask from some extra money. You so this you tip the guy who's making the food. You tip the logistics partner. Sir, you like the food, now you can tip additional. But the fact is that today Zomato is profitable, and Swiggy is still on 2,500 crore loss. So don't think that I'll take the shortcut in life, which is that investor will put in money and I won't have to fight in the market. End of the day, you don't want a situation where there is no further investor to invest at your valuation, and you are on bad unit economics. So, now once the funding winter started, I mean, you look at the way Zomato has come back. I mean, I'm amazed. They have these. They try two new strategies every month, like Google, and if some strategy does not succeed, they shut it down. But they keep on trying that which way we can make ourselves more profitable, because it's an operationally heavy business. It requires a huge amount of money, and they have to be very conscious that end of the day, if the investor does not stay with us, we might end up like WeWork, which went from $47 billion to bankruptcy, because WeWork was having the best quality area in the city, building a 7-star infrastructure, and the end consumer was the gig economy person who was in and out of jobs. So the business model was flawed. The company went from $47 billion to zero. So, so these operationally heavy companies like Blinkit and, once they try to increase revenue, their losses go 5 times. So, end of the day, I mean, I'm giving you the best example out there in the market. You open the Zomato app and you just study each action you take has a monetary benefit for Zomato. And, that is how they have turned back. That is how uh, they have, tried to become positive on unit economics. And 40% of the startups actually shut down after COVID. But those who survived, they changed their business. They, a lot of them like moved online. Actually, that was the biggest pivot in the business model which was available. And there were people paying attention to stock market investment, ed tech companies. Everybody was learning something. So a lot of these companies pivoted, but actually 40% shut down. I hope I
So,
You
answered.
can go ahead.
sir, a small addition since you mentioned about Zomato. So, I was following the Nikhil Kamat's show, and where he had called in some big restaurateurs operating in the space, and they pointed out two things why this kind of Zomato or Swiggy is excelling in this field. They said that one is the discounting that they are offering, and the second is the discovery of the food items, right? So other than this, if we look, then currently ONDC is being in the development. Once that comes into play, probably the delivery side can be taken care of. So how do you see that giving customers discounting as a value proposition, shouldn't it backfire in the long run?
See, there is no broad answer to tell you whether discounting is right or wrong. The fact of the matter is that people are used to a certain business services in the market. You are a new player. You want all of them to come to your platform, because the more uh, services side and the more customer side come to your platform, the more will be the value of your platform to later on monetize the platform. So in India, what happens is that the numbers are huge. I mean, Meesho has 14 crore customers. And so the numbers are huge. But what is the average revenue per user? 360. So I mean, so monetizing is not easy in a country like India. Look at Paytm. I mean, Paytm is still in a loss. And Make My Trip has been there since 20 years. Just last week, it declared that it turned into a profit. So, a lot of times Paytm was lucky because its shares were listed in the US exchange. So, it had 50% online travel market share. Now, the investors sitting in NASDAQ always said, we love this 50% market share, don't lose this market share. So, they never increased prices. They kept on selling at a loss, because the value of the share was so big there, they could raise anytime $100 million or $200 million. So this is a lot of companies are doing, but with these operationally heavy companies like Zepto and all, they don't have a choice. I mean, nowadays, if you order a banana or a snack from Zepto, a grocery item, it'll cost you twice or thrice, because this guy is really billing you very hard. Like instead of selling you 6 bananas, it will offer you 24 bananas. And of course, the price will be high. Look at the price of eggs. You used to get egg at 5 to 7 rupees. Now they sell it in 12 packs, and it's costing you 14 rupees per egg. So they're trying all these strategies. Those who like Swiggy has not been able to nail it. I mean, I feel that Swiggy will have a larger problem, and it will see a down valuation in its future rounds. But Zomato has been able to nail it.
Thank you, sir.
Thank you.
Kirti, you can go ahead.
So my question is that what are some of the mistakes that the startups commit during different series of funding stages, and how can the startups avoid the same?
Well, the biggest mistake which startups make is that they create the wrong business model. So they forget, most what is happening is that more than 50% of the investments in the market are technology investments. For the simple reason that technology is scalable by using the internet, whereas the offline costs a lot, especially in a country like India where the rents are so high that every 6 months the businesses close down and new one opens up. So, uh, so the startups guys who are technology guys, they feel like creating a product because they know technology. But once they create a product, they forget that the biggest aspect of a product is the customer. If the customer is not willing to pay for this product, what is the use of this product? And 92% of startups which shut down are because of a wrong business model and you believing that your product has a customer. So I've seen that what investors and these startup guys are doing nowadays is not nowadays, since a number of years, because we are an English speaking country, so we have a lot of affinity for whatever happens in the US. So they copy the models which happen in the US. For example, this 10-minute delivery, I mean, it was popular in the US because they have to take a car and go to the malls to do their weekend errands. But here you have the kirana guy sitting next to you, and then also they started the 10-minute delivery. So a lot of these models are actually flawed, and that is the biggest thing. And of course, there are other things like these guys. Most of them are young people like you. I mean, don't mind when I say this, but they have fights in the team many times. Like I invested in a company. One guy was a hardcore educationist. The other guy was a hardcore businessman, so they never agreed on the way forward, and ultimately they fought, and one of them said that you give your shares back because I'm getting an investor who's saying that why should we have a dead founder there on the cap table holding so much equity. But this guy did not give the shares back, and ultimately the company closed down. So those things happen, and of course there is obsolescence a lot. Technology changes every 3 to 6 months. We had a huge conversational AI theme coming in, and everybody was shouting on the top of their hats. And just last week, Satya Nadella of Microsoft is on record to say that Google nailed it. Google turned around, created its own generative AI, AI, in build the AI in all their products, and now OpenAI is no longer the hottest thing. It has, gone from a star in 3 months to back to being a wannabe. So technology also has obsolescence. So all these things.
Thank you, sir.
Welcome.
Komal, you can go ahead.
Okay, so my question is like family businesses is one of the most go-to sources for financing, but based on the old economy business model and new economy business model, like can there be a possibility of different approaches? Like as there is a difference in the perspective of old economy business model and new economy business model, and also if there is like equity funded, there can be the tussle between the investors and the founder of the company. So, what are your approaches on that?
It's a very good question, Komal. Let me tell you very frankly, the new generation mostly tells their parents, you made huge money, but we don't want to run your business. This is true for more than 75% of the kids of industrialists, and there are people in the market who specifically are targeting the kids of those industrialists who don't want to run their business. So they will offer them a fancy new thing. Let's create a new thing. You put in the money, you have the money, we will create it for you. And so that is also a separate investor class. But let me tell you very frankly, my personal view is that that you had the kids of industrialists who did very well. Even like K Capital was, he's the son of the Onida family. Uh, so this guy, he studied from the US, because a lot of these industrialist people are studying outside, and he could see that investments will become big in India. So he opened K Capital 15 years back, Sasha Mirchandani. So, and he became a VC. He left Oneda, and he did not work on that. Even this guy, American Swan guy, Rajpal, this guy had a CD making unit in Chandigarh, which was around 100 crore unit. He left that unit. He opened his own apparel brand because he had taken experience from Benetton as their CXO. So he opened American Swan and got $20 million funding. So your parents don't know what you know, and your exposure levels. The world has changed after 1998, 99. I mean, you look at the flow of money towards the asset classes, and you will say that it does not make sense to have a business which is asset heavy, which demands a lot of money, which throws out maybe 10 to 20% profit, and maybe 50% of the business is in cash. So Modi ji is always chasing you. So it doesn't make sense. So it's better that using your exposure, you try to develop something new. Create a family office. Create a family office. Start investing small amounts of money and learning from the investor calls which happen. And maybe you can yourself join a startup and learn from there 2 3 months, 2 3 years, and then maybe start up your own company. So this is what one of my clients did. Institute of Clinical Research of India. They were very big in clinical research education. India's #1. So their daughter studied from UK. So as usual, she didn't want to join the family business. So she opened her own edtech company, and she's now making some investments also side by side. So, and the second question I missed, Komal, sorry.
Yeah, second question was like, what should be the approaches? Because in the new economic business model, if we have the equity funded, then there can be the tussle between the thinking or the perspectives of the investor and the co-founders or founders.
See, Komal, I don't blame you for this question, but the mentality of the old economy people in our country is that they want to keep 100% equity with them, even if their company goes only till 50 or 100 crores. But today Jeff Bezos has 16% equity. He's the richest man on the planet. And you have Elon Musk holding less than 40% in all its companies. And Nyka's founder, she owns 54% of Nyka, in spite of the fact that she's a first generation entrepreneur, an ex banker, and today her company itself is more than $1 billion. But she holds 54% because she was a banker, so she understood कि ज़्यादा dilute नहीं करना. So, but the fact is that the fund guy is also interested in your growth. So don't believe that if they are fighting you over something, it is for your loss. They and the smart ones, they know that अगर ये founder चला गया ना तो ये company हमसे संभलेगी नहीं. All of them know it. If the founder moves, the company goes, because the whole system has been built by the founder. So, I mean, don't be very suspicious about external investor. And if you get an institutional investor like Sequoia who puts in money for 10 years, then 10 years तक तो वो कुछ नहीं पूछ रहा ना आपसे. He's just asking for your cash flow every month and your audited balance sheets. So I mean, that's my view on that.
Yeah, so thank you. It was very insightful.
Thank you.
Nikhil, you can go ahead.
So you talked about the importance of reading books, especially non-fiction. So, like, can you please tell us any practical knowledge takeaway from your personal experience where you applied some knowledge from the books you have read?
See, I'll tell you the people like us who are reading books since decades, sometimes we are very tired कि इतनी बड़ी book पढ़ी उसमें से total 2 pages का ज्ञान निकला. So, but the thing is that to understand the mentality behind the founder, you have to read it. So I was like, when I was in college, I read Rich Dad, Poor Dad. So, I could understand that basically, debt is not bad. I could understand that most of the richest people in the world have 50% debt on them. Those companies have more than like they're 50%, they have a lot of debt. And I could understand that the success is in the balance sheet. The success is not in the profit and loss. And I could understand that investments, see the world, just think of it. The world favors rich people. Every country has an investment visa, a golden visa. Just invest 2 crore, you get the citizenship. And if the capital gains tax is 0 or 10% or 15% maximum, but the income tax is 30% in India, 45% in UK, and if you stay in UK more than 7 years, it is 55%. यानी सैलरी वाले की तो और कैपिटल गेन्स टैक्स 10%, 0%, 15%, दुबई 0%, सिंगापुर 15%, 10%. So they are saying become rich by being an investor. We are taxing you less. Take the citizenship of our country. Put your money here. Invest in our. Keep on investing here. We will not charge you any tax. The total amount of tax paid by the top 100 richest people in the world is 3%. 3%. And if you are doing a job, even in the best of companies, you're paying 30%. So, Rich Dad Poor Dad was one. I read Losing My Virginity by Richard Branson. This guy was like stayed in a countryside, and he used to try all kinds of things to become rich. And he met all kinds of people who wanted to take advantage of him. And it was simply lovely to read that. Then I read the biography of Sardar Vallabhbhai Patel, that one man's conviction can create a country. One man's conviction. You look at Lee Kuan Yew of Singapore. It was a swamp. When they separated from Malaysia, it was a swamp where they had all kinds of diseases. And he created the most developed country in Asia in his lifetime. And, he never became rich. He just ensured that because the point is, if you are sitting on the top and eating money, your work will never happen. Your organization work will never happen because everybody will know the culture of the company, the culture of its partners. The company will never grow big. So this is what Lee Kuan Yew did. So these are the magic of thinking big. Like Oyo Room, Ritesh Agarwal. He used to earn 2 lakhs a month when he had a hotel in Gurgaon, and he was 19 years old, 20 years old. So he's on record to say, मैं तो उसी में खुश था 2 लाख में. But my vision was to be the biggest aggregator of hotels in India. So the magic of thinking big was one. Then Joseph Murphy's The Power of Subconscious Mind. That many times we feel so sad that हमारे अंदर ये नहीं है, we don't have this, we don't have that, look, he has that. And that sets off a chain of thinking. And every time we are discounting ourselves, okay, this guy has that, that is why we did not make it big. This guy has that, that is why. So you have to understand the strengths inside your subconscious mind, because God gave equal consciousness to everyone. So you have to tap into your subconsciousness. So all these things, I can recommend you a list of books on LinkedIn if you guys approach me. And Coffee Can Investing is one. Saurabh Mukherjee of Marcellus. All these books. It does not necessarily have to be about business. It can be like Jared Diamond's Collapse, about civilizations, the clash of civilizations. All awesome book.
Okay, thank you, sir.
Thank you.
Harshit, you can go ahead.
strategies or methodologies you believe are essential for identifying promising investment opportunities in today's market?
Well, in today's market, okay, if you want to get ideas from me, see, people are tired of screens, iPad, your watch, digital watch, your mobile phone is the biggest culprit. So digital detox has to come in as a big theme. So, this app came Calm. Calm gives you nature music. It is valued at more than $1 billion. I mean, so the thing is that we are all the time on screens, and the screen is giving you information through artificial intelligence. So they are giving you the exact information you want. So what your mind, see, we are monkeys beneath us, right? So the mind starts thinking, I have to match this information, this speed of information. So mind starts running very fast. So what happens is even your normal life reactions becoming very fast. You react very fast. So that's why your mind is tired all the time. So digital detox is one. EdTech is gone. Nobody is investing in EdTech. AR VR is gone. I had predicted that long time back. Metaverse is gone. I had predicted that long time back. Um, so co-working spaces, still a lot of business is there, and fintech, a lot of area is there still to be tapped because right now the unfortunate thing is Indian families are sitting on a 30-year low in terms of savings. But the desire to consume is the same. So everybody is buying big cars. Nobody is buying small cars now. Everybody wants an SUV. So everybody wants a good fridge. Everybody wants a LED TV. So everybody is taking loans. So the lending opportunity is huge in fintech. So all these things in talk, environmental theme is very strong because look at what is happening. Panama Canal has gone dry, and it is allowing only 50% ships. So climate. You look at what is happening around us. Look at what is happening in Delhi. I mean, we are sitting on. If a person lives in Delhi throughout his life gets cut by 10 years. 10 years. So pollution is a huge thing. All these things.
Thank you, sir.
Thank you.
Shivani, you can go ahead.
Hello, sir.
Hello.
So, as you mentioned in financing options, crowdfunding is one option which is not that popular compared to the others. But with increased awareness among retail investor and upward trend in number of startups, like what could be the future of crowdfunding in India?
See, the crowdfunding problem is that it is very difficult to manage. I mean, the government angel norms, taxation norms are changing all the time, and the tax department is giving an entirely different meaning to the capital gain which is earned by the angel investor. So they are saying that it is taxable on the income side also. So, once they tax it on the capital gain and then it becomes a part of their income, and then they pay 30% income tax also. So it's a double tax. So uh, all these angel guys are fighting out there. So crowdfunding is, I've not seen successful. If you consider 2 lakhs ticket and above these angel networks, then that is successful. But if you consider crowdfunding like 50,000 rupees or maybe 10,000, 5,000, actually the whole thing is that इतने कम पैसे से ना स्टार्टअप का कुछ होता नहीं है. मतलब end of the day they raise 5 lakh, 10 lakh. I mean, it will just get burnt in 2 months and then they will be again in the market. So founder will keep on raising money all the time. What will he do with the business? So that is the whole problem, Shivani.
Okay, sir, got it. Thank you.
Thank you.
So, that's it. We don't have more questions now.
Thank you. Thank you so much. I was really happy to see so many students because I thought पता नहीं निश्चिंत कितने बच्चों को बुलाएगा. So thank you so much. And I'm always available on LinkedIn and happy to share ideas over LinkedIn chat or meet also sometime possible in Delhi. And Nischint, I will request for the video. And thank you so much, all of you, for sparing your valuable time, wearing these dashing uniforms and having the patience to sit here with me, talking all the trash. So thank you, all of you. God bless you.
I would like to express our deepest gratitude to Tushar sir for conducting such an enriching session and for choosing IIM Ranchi as a partner in your recruitment efforts. Thank you, sir.
Thank you. Thank you, everyone. Thank you, Nischint.
Thank you
Have a
so
good
much.
day. Thanks. Bye.
Sir.